welcome to the How's My Financial Health Doc YouTube channel. Today I'm doing a mini series on human behavior and the behavior of investment.
I am a senior director and associate portfolio manager at Vector Global Canada. Vector Global is a portfolio manager. We're based in Toronto, but we are actually an American firm. We provide asset management to clients around the world. I myself am a former trader with one of the big banks in Canada, and I've been managing either individual or institutional assets for over 25 years.
Okay, let's move on to a second common mistake that investors make. What would you say is the second most common, or something that you've seen very, very often?
I would say confirmation bias is a very common one. I think you and I discussed it in terms of the overconfidence. They're kind of one and the same. That one's very, very common. Confirmation bias is pretty common in many areas. In politics, for example, where a person's own point of view, their subjective confidence and their judgment relies a lot on their own judgment and their own experience, right? We see that today around COVID, for example. That's a great example of confirmation bias. Somehow doctors and scientists aren't good enough now to tell us, what's the right move to do with, how to handle COVID. We sort of decide for ourselves what is better, and ignore the professionals in the field. That's an example of confirmation bias. So that does happen with investing as well, where, if you are in tech, you tend to invest mostly in tech. If you are in real estate, this is a big one. If you are in real estate, which many people are in Canada and especially in the GTA, then there is no better asset class than real estate. I'm not denigrating real estate. I'm just saying that if you are in that space, that is your preferred asset class. And so you give it a preference. That also occurs a lot in the investor profile for Canadians. We have a very pro-Canadian bias in our portfolios.
Interesting.
In relative terms, Canada is 3% of the world market. Yes. And yet some Canadians are 100% invested in Canada.
Interesting.
And very little exposure outside of Canada, or at the very least, they have a very, very overweight position in Canada, 30, 40, 50% Canadian exposure. We're 3% of the market. So that kind of bias exists all over the place. It's manageable. And, if you did have a real estate bias over the last 10, 20 years, you probably made good money.
Yeah.
But there are moments where that confirmation bias can work against you.
Absolutely. So in that same, you mentioned overconfidence. There's also in that same optimism, right? So yes. We're very optimistic about one asset class or one stock, for example, right? Right. You mentioned earlier another common mistake that people make is being under-diversified or over-diversified. And this can come into play in the confirmation bias too, right? I could be so under-diversified that 100% of my portfolio is in Canadian equities, or a good chunk of my portfolio is in REITs and real estate and other type of real estate investments.
Well, there's a danger in both being under-diversified and being over-diversified, but the dangers are obviously very, very different. This again is very connected to that emotional investing, what again, if you're in tech, if you're in real estate, you're probably overweight those particular asset classes. But that's what leads to under-diversification, right? If you're very, very overweight real estate, some people are, their entire net worth is in real estate. So it's not a bad thing. You've probably made good money over the last few years, but you are now under-diversified. That is just a mathematical fact. On the other hand, being afraid to take a chance, there's a risk in that. And that's when you are over-diversified. I don't think you should be afraid to take a chance on a particular sector, or perhaps overweight a specific asset class. In the case of real estate, that would have been good. There's no doubt that at certain points, one asset class will outperform another asset class. So at one point, gold and resources will outperform industrials. Technology may outperform utilities. Healthcare might outperform financials. So, and obviously vice versa, any of these can be the opposite. At any given point in time, that can happen. So evaluating the current environment is very important in order to make decisions that will help your portfolio. Warren Buffett, one of the probably the most famous investor in the world, he says that there's no shame in using index funds. And he's right. For someone who wants to do it themselves, sort of a set it and forget it solution, index funds are quite diversified, both in the securities themselves as well as in sectors. However, the only problem is that with going with index funds is that you're going to be so diversified that you won't outperform.
Yeah.
And you'll simply ride the ups and downs of the markets in the long term. In the long term, the markets have shown X amount of return. That's what you'll get, minus any kind of tracking error. But I do believe in being active. So I believe in having a diversified portfolio, but with reasonable adjustments to your concentrations in order to attempt to achieve better returns than the markets.
Now, I've seen some of the portfolios that you've built. Even in your portfolio, you use ETFs and index funds. I've seen it.
Yeah.
But what you're saying is, yeah, you could follow the market, but you should be able to use your skills, your experience to say, okay, when is the best time to be in this versus that? When is the best time to go in? When is the best time to pull out? Even though you're using ETFs and index funds. And
Right.
And you're not just using ETFs and index funds. You're using individual stocks as well. You're using other asset class like bonds and stuff like that. So it's not to say that, using index funds or ETF is the only way to go. And it's not to say that, active funds is the only way to go. I think there's a good medium where you can actually play both to your advantage.
The great thing about the capital markets is that there's many, many options. And so a tailor-made solution for an individual investor can be found. It shouldn't be cookie cutter, one for everyone, one solution for every single investor out there. Everybody has different tolerance to risk. Everyone has different needs. Everyone has different income levels, different family situations. And different priorities. That's a big one. So, making a customized portfolio, I think, is important. And whether you do it yourself, which many people can do, or whether you use a professional, I don't believe that there's a one size fits all.
Obviously. Now, you mentioned your do-it-yourself people, and if you're doing yourself, like I'm a physician, my full-time job is to see patients. My full-time job is not to sit in front of a computer and watching the numbers go up and down. So obviously, I cannot be an active participant in the market in the sense that I'm, daily trading. So for a do-it-yourself individual, a follow the market may be a good initial strategy, unless you want to become a little bit more sophisticated. But it's a good way for you to get into the market if you're the type of people that says buy it and leave it type.
Set it, forget it.
Yeah.